you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. Bob Iger recently, in an interview on CNBC, a business news channel, made it very clear he wanted to try to sell or look at options for raising money from ABC, their cable networks, and ESPN. That took a lot of people by surprise. They were kind of shocked because it's not something anyone really thought was going to happen, although I have to say it's been obvious for a while that it didn't seem to make sense that Bob Iger and Disney controlled all these different businesses that just really weren't working well together anymore. Now, investors want Disney to sell off pieces of the company before it totally collapses. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you. Trying to get to 30,000 subscribers, so if you can't subscribe, please do subscribe. Coming from Yahoo Finance, Wall Street ponders splitting up Disney. Why not make a clean break? It is amazing because people were not discussing this. Mostly analysts were just thrilled with the idea that Bob Iger was coming back to Disney. The idea people had was, okay, great, he can come in, he can fix the company. Chapek was such a mess, the CEO before Bob Iger, who of course Bob Iger put into that position. But the truth of it is, Bob Iger is not that good at what Disney needs right now. He's not a strong manager. He was very good at getting a hold of other people's really important passion projects like Pixar, like Marvel, like Lucasfilm. No one else got a hold of those things. Those were very important properties to get, but they've been really, really badly run down. And at the same time, they've pushed the woke agenda into all these projects so that the people who really love these properties for all these years just don't like what they're putting out. And it's as if Disney completely doesn't care what customers actually think of the products they're producing. What's even stranger is some people even believe, and I go back and forth on this myself, I don't understand what's going on at Disney, that they're doing it deliberately to just get rid of classic American intellectual properties and brands because it damages the American culture, which a lot of people in powerful positions in business seem to want to do. For example, Target, for example, Bud Light, and absolutely, for example, Disney. And when they say splitting up, they mean taking pieces of Disney like ABC, but really like gigantic pieces of Disney and cutting Disney up and selling off pieces of it so that the company would be unrecognizable, which is almost definitely going to happen because Bob Iger said he wanted it to happen, at least when it came to ABC and their cable channels. 2019 was a year of big wins for Disney. Its streaming service, Disney Plus, drew 10 million subscribers in a day after launching. The company completed a $71 billion acquisition for Fox's entertainment assets, opened 2 Star Wars theme parks, and released the second highest grossing movie in cinematic history, Avengers Endgame. It should be said they really only spent around $50 billion, a little bit more, on the Fox acquisition because a couple of major pieces they did not acquire and someone else acquired at closing when the deal actually went through. The wins encapsulated Disney's strength as an entertainment behemoth that could cross-market its strong intellectual property everywhere from theaters to theme parks and even directly into your home via streaming. But flash forward nearly 4 years later, and the merit of having all those assets under one roof is in question. CEO Bob Iger himself has raised the prospect that the company is too big, and some on Wall Street are advocating for a breakup. The idea that Disney would control so much of the way their content is distributed, especially them doing their own direct-to-consumer, is really asking them to do something that no other company was really set up to do. Netflix wasn't built that way. Warner Brothers Discovery wasn't built that way. Paramount not built that way. Really, no other companies were built that way. And streaming is still not working out for Disney. The other problem is they lose a lot of discipline where they take all the content and they only sell it to their own distribution outlets because they don't have customers saying, hey, your budgets are too high, I'm not going to buy your streaming stuff. When they did a deal with Netflix for Marvel shows, they did 60 Marvel shows for a total cost of $200 million in 2014. Now when they do 60 Marvel shows, the budgets are around $25 million per show. And then they wonder, why is Netflix successful and why are they not successful? Well, Netflix pays more than $3 million a show typically, but they only pay $15 million an episode for Sandman, and they almost canceled Sandman even though it was one of their biggest hits because they didn't want to pay as much as $15 million a show, and Netflix has better distribution than Disney+. Go figure that one out. No wonder they're not making money. The company's parks business is slowing. Its linear TV division is declining, and so are subscribers to its flagship streaming service, Disney+. Not to mention, the media giant seems to have lagged competitors at the box office. Well, that is not that they seem to have. They absolutely have. They are behind their competitors at the box office. Quote, given the thinking you've done about the future of Disney, why doesn't it make sense to create two Disney companies? One focused on parks, Disney+, and then the studio IP that drives that flywheel, and then one on everything else. When they say flywheel, for example, the great intellectual property that they have that then can be utilized for merchandise, for shows, to get people into the theme parks, and so they can make continuous money on it. So why not make a clean break? MoffettNathanson analyst Michael Nathanson pressed CEO Bob Iger on the earnings call last week. Nathanson later clarified that everything else would include Disney's linear networks, ESPN+, Hulu SVOD, subscription video on demand, Hulu Live TV, and Disney+ Hotstar. Quote, I'm not going to comment on the future structure of the company or the asset makeup of the company, Iger said in response. As I've said, we're looking at strategic options both for ESPN and for the linear networks, obviously addressing all of the challenges that those businesses are facing. Amid the declines in linear TV, Iger said last month he'd take an expansive look at the entertainment giant's traditional TV assets, signaling the potential strategic options that could include a sale. At the time, Iger admitted the current distribution model is definitely broken, explaining Disney's linear TV assets, which include broadcast network ABC and cable channels, FX, Freeform, and National Geographic, may not be core to its strategy any longer. When they say not core, they mean like, why if I own a restaurant, do I need to also own a dry cleaning operation? Like completely irrelevant to the core business. He reiterated that thinking on the earnings call, calling out three businesses that will drive growth and value creation over the next 5 years: film studios, the parks, and streaming. Part of that streaming strategy centers on ESPN, which will eventually become a fully over-the-top direct-to-consumer DTC platform. When they say over-the-top, they mean fully direct-to-consumer, the same way that Disney Plus and Hulu are. Analysts and media watchers have cautioned the network's full transition to streaming will be a difficult journey, particularly when it comes to the high costs of sports rights and consumers footing the bill for an additional streaming service versus watching sports as part of a cable bundle. Selling off the linear networks will also be challenging given the secular declines in linear television networks amid escalating cord-cutting trends. That thinking will be further complicated if ESPN is not included in a potential spinoff. A spinoff is like if they would take the company and sell part of it to the public, or they might sell all of that company. Going back to the restaurant metaphor, if I own a chain of 100 restaurants, I might take all the ones that are in Texas. Let's say there are 20 of them in Texas, and then just call it like Texas Restaurant Incorporated and have a new business that's just those Texas restaurants. Still, a company split would allow Disney to offload its debt, eliminate loss leaders, and provide a clearer direction for its future in a fragmented media landscape. So like Nathanson suggested, why not just make a clean break? Well, there is no clean break, Bank of America analyst Reeve Ehrlich told Yahoo Finance, explaining how Disney's assets feed off one another to power the business, with the studio IP driving the parks, while linear networks provide the cash for Disney to funnel further investments into growth areas like streaming. Along with that, the value of ESPN is heavily tied to ABC due to its massive reach on broadcast. Yet ABC is part of the linear business Iger potentially wants to unload. Quote, I thought it was pretty clear that Disney wants to own the majority of ESPN. That is what Iger said. How do you want to do that without also having ABC and the stations? That's the part where I have a lot of difficulty, she said. Instead of separating the businesses, Ehrlich suggested leveraging the brands to create value, citing ESPN's $2 billion sports betting deal with Penn Entertainment as one example. Quote, there's a lot of intrinsic value in the IP that they control, she said. Yet Nathanson, who lowered his price target on the stock to $115 per share, from $120 per share, so he's losing confidence in Disney, argued that value is not fully realized within the current company structure. Quote, given that Disney is in the process of exploring all options when it comes to its future mix of assets, meaning the divisions that it's going to actually wind up still owning, we think there's a clear case to be made that under any scenario, Disney's assets are worth materially more than its current enterprise value. Nathanson wrote in a note to clients following last week's earnings results. I do agree with this guy, Nathanson, that there's about $100 billion of value tied up in the poor management of the way the assets are all smushed together right now. It doesn't mean that spinning them off would make them so valuable, or selling this piece and selling that piece. They really do need to do a much better job of managing each of the individual businesses they're in. Obviously, it's not just movies, and it's not just theme parks, and it's not just cable channels. They are in a lot of different businesses, and they need good managers that are focused on pleasing their customers. And they really do have to purge the woke stuff. Quote, perhaps the easiest way to close that gap would be to create a new company, or NewCo, with Disney's parks, experiences, and product segment combined with Disney Plus and the studio intellectual property that fuels these flywheels. This asset would likely trade at a premium valuation given the high moat, iconic assets, and strong revenue growth. We have no illusions that the market will be generous in the valuation of these businesses. Unlocking value. It's these guys, they know, I know, you know, everyone knows that there's at least half the country that is very unhappy with the way that Disney is treating customers and what kind of content they're producing. That is a much bigger factor than even the structure of these companies. It's actually as big a factor, or even a bigger factor, than the management of these companies. Because if you're going to go ahead and you're going to produce like the Snow White movie they did, which just shows them going on a worse direction from even where they were going with The Little Mermaid, how is that going to ultimately build value for people when people just get completely burned out on it? And for another thing, it's one thing not to respect the classics like they're doing with The Little Mermaid and they're doing with Snow White. The new stuff they're producing that doesn't respect the classics isn't even good. If it was good, if there was a whole segment of people that were like, wow, I really love this, then there'd be a market for it. But it's a diminishing market that people are just like, wait, what are they actually doing? And there's no interest in it, like what they just did with Haunted Mansion. There was no interest in it. It's a strategy that's been floated for other legacy media giants like Paramount Global, which has long been viewed as a potential acquisition target due to its small size relative to competitors, along with its vast array of brands like BET and Showtime, which have both received interest from buyers. On Wednesday, the Wall Street Journal reported Paramount dropped its plans to sell a majority stake in BET Media Group after concluding a sale wouldn't result in any meaningful deleveraging of its balance sheet, meaning that making the sale would not knock down their debt. And apparently, that's a concern for them. Lionsgate has also leaned into this trend by splitting its studio and Starz business, which will take place in the first quarter of 2024. Steve Beck, founder of consultant firm CG42, explained to Yahoo Finance that this new age of value creation is representative of the streaming first era. Quote, when you start to recalibrate for the direct-to-consumer model, which is what we're starting to see with Disney and others, you recalibrate the business, and there's aspects of that business that you just fundamentally do not need, he said. Bank of America's Reef, though, maintained divesting likely won't be enough to solve Disney's myriad of problems, although there are arguments that can be made on both sides. Quote, I'm not in the camp that says Disney really needs to be split up. Having said that, I think all options, and Bob Iger has made this very clear, all options are on the table, she said. The number one problem for every business is, do you know who your customer is, and are you taking care of that customer? The second issue is management of the business. You've got to be able to manage it properly with people that know what they're doing so they can deliver for that customer, and at the same time, they can control their overhead expense, and they can make sure they're hiring the right people and that your employees are taken care of so you can retain them. Keep the wheels turning. Take care of your customers and keep the operation running smoothly. And then really lastly, but it's also very important, your capital management. So when you have money invested in the business, are you getting a good return on your investment? Are you doing it efficiently? Those things are not happening at Disney right now. Bob Iger does not seem to be the kind of guy that's capable of fixing those things. He's very good at finding talent. Kevin Mayer and Tom Staggs, who he brought in as consultants, who used to be executives with the company, do have some great skills. Maybe they're going to help out. But we are looking at a future where big pieces of Disney are going to be cut up and probably sold off. I used to think they would never sell the Lucasfilm division or the Marvel division, but I think anything is possible because while Disney doesn't make any sense the way it's structured, it needs to get cut up until it does make sense. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.